Thanks for joining us today on Morning Markets. I'm Marella Fernandez. Here are the stories you're tracking in the BNN Bloomberg newsroom. Oil prices falling after the U.S. and Iran reached an interim peace deal to reopen the Strait of Hormuz. Both sides still need to decide on the final steps, but the agreement is expected to be signed in Switzerland on Friday. The plan extends the ceasefire by 2 months and begins talks on restricting Iran's enrichment of uranium. Iran is meant to reopen the strait immediately after that deal is signed. Prime Minister Mark Carney says the war in Iran will be topic number one at the G7 in France. He adds the war in Ukraine is also a key issue. Carney says Canada has been clear that a durable ceasefire must ensure safe transit through the Strait of Hormuz and also address Iran's nuclear program. It's unknown if Carney will meet with the American president at the summit. And shares of Fox and Roku are under pressure in today's trading after the media giant announced it's buying the streaming platform. Fox will buy Roku for $160 per share in cash and stock, valuing the firm at $22 billion U.S. The deal will blend Fox's sports, news, and entertainment channels with Roku's streaming platform and give it access to more than 100 million global subscribers. Existing Fox shareholders are expected to own 73% of that combined company. All right, let's have a look at where we are in the markets right now. Obviously, the TSX and other North American markets are liking the news coming out of the Middle East, with the TSX up 0.9% or 323 points to 35,261. South of the border, the same. The S&P is up 1.7% or 124 points. The Dow Jones gaining 1.3%, 645 points. And take a look at the NASDAQ. It's up 2.6%, also a 600-point move on the day. Oil prices, as we said, slipping today after the U.S. president announced that possible deal with Iran to reopen the Strait of Hormuz. The development also caused equities and bonds to jump. Let's talk about this with Brian Mulberry. He's chief market strategist for Zacks Investment Management. Thanks for joining us today.
Absolutely.
So West Texas Intermediate last night looked was down over 5%, close to 6% so far in the day. Do you see the drop as just temporary until there's a clearer understanding of how much supply can get through?
Well, I see the drop as a little bit more lasting this time. We've obviously seen volatility as the negotiations haven't really been all of that trustworthy, if you will. But this time, the fact that they're actually going to physically sign a document and that there seems to be activity in the Strait of Hormuz, that seems to me to be a clear signal. And we also broke through the clear threshold of $80 a barrel. I think that's an important moment, and that we're likely to see this type of a decline last longer than what we have over the last couple of months.
Okay, so you don't expect the volatility to continue for the rest of the year, or do you?
Well, I mean, obviously, it all comes down to the actual traffic normalizing through the Strait of Hormuz. We're seeing positive indications and that ships are preparing to sail, all of that kind of stuff. But we need to get back to that regular traffic of 100 to 120 vessels a day going in and out of the strait. Obviously, we've only seen a handful in the last 24 hours. That's better than zero, but it's not the normalized traffic. So it comes down to the actual movement of the goods through the strait. And we expect that to happen immediately once the memorandum is signed.
Okay, so let's talk about the markets from last Friday. SpaceX, of course, stealing the spotlight last week. Is it something you invested in? Why or why not?
We did not. For us at Zacks, we're all about earnings, which is just another way of tracking profitability. And while SpaceX is a gigantic company with 3 distinct businesses, we're still not seeing a clear road to profitability, at least in the short term. In the long term, there are definitely models that are out there for them to capture a lot of revenue, but there are some questions for us. We know that Google and Anthropic are going to pay $2 billion a month for data out of XAI, but XAI is spending even more than that, 25 to 30 $30 billion in capex, right? So they're not cash flow positive there. There are some indications from Starlink that you have enough subscriptions to carry the day where you might generate enough revenue, but we're just not clear yet. We also want some of the dust to settle. Obviously, it's getting a nice pop. We don't necessarily expect the price to ever come back down below the issue price of 135, but once all of the institutional trading settles down after the inclusion into the NASDAQ, we feel like there might be a better entry point than what we're finding right at this moment.
All right. Do you feel, Brian, that other tech stocks got hit as investors were looking to reroute their money to SpaceX?
Yeah, absolutely. I mean, and it's not just SpaceX. When you look at OpenAI, Anthropic, and even Google is going to do an $80 billion raise in the equity markets, you're talking about $350 billion plus in opportunity for investors to look at it, but they're going to have to sell something to buy into that opportunity. So I do think part of the volatility we've seen in the last 5 to 7 trading sessions has been exacerbated by the fact that people are raising cash to participate in these IPOs.
All right. Are there certain pullbacks at this point you would invest in?
Yeah, I think now that we have a little bit of a dynamic here, again, a better understanding of where the future of commodity prices are going to be. We're even seeing interest rates coming down measurably. That lowers the pressure, if you will, on the cost of capital, even on a global basis. That's better for growth all aboard. So now I would say if there are pullbacks, and there could be a few through the summer, that those are buying opportunities for high quality companies with large moats and clear profitability.
Okay, one of them I know you're watching is Apple. Are you already invested in Apple? Are you looking to pick up more, or are you looking to start a position?
We actually have owned Apple for quite some time, and we're adding to it through some of the pullbacks that you're finding, right? Some of the valuations that we've seen in the technology sector have gotten a little bit crazy. Apple's been a little bit behind, but starting to catch up. We feel like they've just done a great job of moderating their spending and not participating in the craziness of all of the capex. They've kept $180 billion in cash on their balance sheet. So if they wanted to or felt like they needed to, they could make a big splash at any one moment. And I feel like the market wants them to, but they're just steadily going about their business doing what they do. They had a really nice cycle of upgrades in the iPhone 17 with 2.5 billion users worldwide. That translates to a lot of revenue growth all on its own. And so I feel like Apple's really in a solid position and a little bit of a buffer against some of the volatility that might happen in the technology sector.
All right, tell me about MCOR. This is one you're watching as well. What do you like about it?
MCOR is one of these names that has kind of come out of the ether in the last couple of years because they're just so good at what they do. It's a construction company, but they do both electrical wiring and plumbing, and they're really, really good at intricate design and build outs. And so that makes them the perfect partner for data centers. When you're talking about having to do the plumbing for liquid cooled GPUs and that type of setup, and also the actual power design is going to need a lot of copper harnesses and things of that nature. The wiring, the plumbing, their business is growing. They've made some strategic acquisitions and they're able to grow with it, and their profitability, their margins are just increasing. And so we feel like this is a name that's done really well over the last 12 months, but it actually has more room to run because of their competitive moat.
Let me touch on something you did speak a little bit about, and that's the fact that we have these other two big IPOs coming later in the year. Anthropic's one of them, OpenAI is the other. And you expect to see people sort of moving their money around to get ready for that.
Yeah, I would expect so. I mean, it's just a huge amount of capital that they're asking the market to provide in these public offerings of the shares. And so I think that there are some people that are going to have to make some choices. Do they sell out of some of the winners that have occurred, or are they looking for a better opportunity from different sectors that are out there? When I look back over the last 90 days, technology as a sector is up almost 30%. The next closest is healthcare at 4.5%, right? So there's a lot of lagging in the other sectors outside of technology. So people are going to have to make decisions. I think I just don't see that much cash on the sideline that could absorb $350 billion in new shares being offered on the public market. People are going to have to make decisions.
Brian Mulberry, good to have you, sir. Thanks for joining us. Brian's a chief market strategist for Zacks Investment Management. Canadian fintech company Nuvei is making a major bet on global payments. We'll speak with the CEO when we come back. Nuvei is expanding its global footprint. The Montreal-based payments company has agreed to acquire Payoneer in a deal valued at about $2.75 billion US. Joining us now is Philip Fayer. He's the CEO of Nuvei. Thanks for your time today.
Thank you for having me.
So this is your company's largest acquisition to date. What pushed the company to make this?
We've been focused on building infrastructure to enable every payment everywhere. And Nuvei has been extremely successful on the pay-in, helping our customers, connect with their customers to collect funds in currency in markets where they operate around the world, about 52 different markets where we're licensed. And today we're operating with the acquisition of Payoneer on the other side for them to do cross-border and payouts. So the combination is extremely exciting. It creates a unique infrastructure capable of handling all forms of fintech requirements for our customers around the world.
Okay, can you expand a little bit more on what Payoneer brings to Nuvei that perhaps your company could not do on its own, or would take too long or too much money to do on its own?
Yeah, for sure. In simple terms, we manage pay-in. So if you're a business and you want to accept payments from a customer in Colombia or the United States or anywhere around the world, one integration to our platform, and we'll manage the ability for you to collect those funds. Payoneer, on the other hand, does the exact opposite. So once you've collected those funds, we'll deposit them in a local bank account. Payoneer allows our customers to have virtual bank accounts and be able to receive funds from multiple sources. Typically, where Payoneer operates are Amazon, Etsy, eBay, TikTok resellers. Well, they'll consolidate that, receive the funds, and then enable real-time cross-border payments. So the combination is really the other side of the coin that we operate on, which is just an incredible opportunity for the combined companies.
Okay, I want to talk about your clients in just a moment, but the companies are going to, as you say, together support more than 190 countries, I believe, and territories. How important is it today to have that global scale?
It's critical. And not only the countries that you operate, but there's also licensing. So, Nuvei is licensed in a myriad of countries. Payoneer's licenses are an extension to ours, including licenses highly desirable in China, as well as India, amongst others. So it's a licensing, it's a local operation, it's a local capabilities, and merging the two together is really a wonderful cross-sell opportunity.
I was going to ask you about the Chinese and Indian markets, how important or how key to the acquisition were the access to those markets?
Very much. We're enabling customers around the world. And if you think about it, China and the United States are locomotives, and the ability to support Chinese businesses as they continuously expand their footprint around the world is exciting, as well as having that local license to repatriate to operate within the Chinese framework, which is, a new framework that many companies are struggling to adhere to. So this is extremely additive to our current roster of clients that are either operating in China that are looking to receive funds from around the world, or expected or looking to enter the Chinese market.
Are those countries, as you sort of touched on, faster to embrace different kinds of payment methods than perhaps North America, or at least Canada?
Well, they understand it quickly. It's fascinating is some of our large Asian companies are opening a new market a month. So just their growth is unbelievable. And to enter those markets, you have to have all the local payment rails. So most people think, I'm going to set up and I'm going to set Visa, MasterCard, but there's local payment options. You think about Canada's Interact, but sometimes there's 5 or 6 different requirements that you need per country, both on the way in and the way out. So yes, it's fascinating. They need the payment mediums. They need the ability to both collect and pay out. And their appetite to expand globally is insatiable.
Okay, so let's talk a little bit more about clients. You mentioned, for example, Payoneer has some of the bigger clients because you're looking to serve digital commerce, essentially, the Amazons or the Etsys, those kinds of businesses. Did you already have those clients on your own? Are they coming through you through Payoneer?
A little bit of both. So, Nuvei services great brands like Microsoft and Ticketmaster and others. Payoneer, and we have a smaller marketplace business. Payoneer has an extremely successful marketplace business where they've been focusing on the Amazons, the Shopifys, the Etsys, and others. The combination is so attractive just because we're going to help them go up market, and we're going to be able to execute around, paymentizing the marketplaces that they support today.
Let's talk a little bit about fintech in Canada. How would you describe the ability to easily adapt fintech in Canada compared to some of the global peers?
Look, I think Canada, first of all, in fintech for us, it's borderless, right? Because businesses have to operate around the world. I think Canada has an incredible framework now. We've set up the MSB. We set up licensing in Canada now that I think has created more clarity around it. But Canada is still such an attractive opportunity. We have great talent, great know-how. We have nothing but capability in Canada. So the way I would frame it back is fintech is an important part. I'm really proud to be Canadian. I'm really proud of our Canadian innovation. And there's so much can-do opportunity in Canada, but it's not restricted to the borders of Canada. We're born here, but we operate, around the world with 5,000 employees.
Okay, are there one or two things you would do within the country or ask of the government, for example, as it moves more towards modernizing the law that they could do, either sort of through regulation or licensing?
Yeah, the couple that come to mind is we've been slow on stablecoin and digital assets. I think that is a wonderful opportunity. I think the fact that we've now set up MSBN regulation is a positive, and Canada's moving in the right direction. But overall, we should be innovating here, right? To bring investment dollars up to Canada so that we could be pioneers. Other countries have been ahead of us. I think stablecoin movement is positive, but we're still many years behind what's just south of the border.
All right, Philip, what else for this current deal? When will it be complete? What else has to shake out before that happens?
There's a regulatory framework, so it'll be first half of 2027. The licensing process obviously takes its time, but we're expecting it in the first half of 2027.
Got it. Philip Fayer, CEO of Nuvei, thanks for joining us. Appreciate your time.
Thank you for having me.
Coming up, we are again watching the price of oil as the U.S. and Iran reach an interim agreement to reopen the Strait of Hormuz this week. Back in a moment. Oil prices falling after the U.S. and Iran reached an interim agreement to reopen the Strait of Hormuz and closer to ending that 3-month conflict. Now, both sides still need to finalize details, with a memo to be signed in Switzerland on Friday. For more on this, we sat down with Eric Nuttall, partner and senior portfolio manager, 9 Point Partners.
We are missing many of the key details, such as will the Strait of Hormuz actually be toll-free? The vice president this morning said that those details are going to be worked out over the next 60 days. And that has a really profound impact. But let's just assume we can take the president and the administration at face value. The strait is open. We'll have ships leaving and, more importantly, have ships entering in. Let's acknowledge where we sit today. The market has forfeited 1.7 billion barrels of Middle Eastern production by the time the lag effect ends. We will have lost roughly 11 million barrels per day of that production. It can't come on stream until ships are actually willing to not just leave the strait and empty, but actually come back. And so there is a lag impact from that. We also have enormous damage at a number of facilities, about 70 in the world. I was in Washington last week, and some of the scuttlebutt was the damage in certain countries is far worse than has been let on. And lastly, of that shut-in production, we're also risking formation damage, productive capacity damage, having been shut in. So the new normal, that what I have coined the day after, we have in print for the past 2 months talked about how energy investors, equity investors, which I am, should never have wanted where we were heading, which was Cushing inventories we think will still reach tank bottoms in the next month. The United SPR, the Strategic Petroleum Reserve, only really had 50 million barrels left of actual usable capacity. That was a really key insight that we put up on Twitter after our Washington meetings. That would have been exhausted by July to August. So we think the U.S. administration was under far, far more pressure than what they acknowledged. And the new normal, so to speak, for the oil market, it's much, much different than what is 3 or 4 months ago.
You mentioned that the market reactants of oil is priced at $65 a barrel. After this latest development, do you still see that as kind of a disconnect?
Yeah, we think that $80 is going to serve as the approximate floor. We will acknowledge that, we'll see the washout today. The short interest in Brent is now at roughly a 5-year high. So from a positioning perspective in the commodity, we think that people have been incredibly bearish. We really tip our hat to the U.S. president. He was unbelievably effective at talking the oil price down 37 times over the past 107 days, talking about imminent peace. And so it really prevented commodity traders from deploying at-risk capital to take a long position. The shorts, I think, are, again, as I've noted, at a 5-year high. And again, from an equity perspective, I think this is a really important insight. The geopolitical spike, the $150 scenario, which many of us thought was very, very possible, was not going to be positive for equity performance. It would have brought on recessionary concerns, demand destruction, demand deferral. That would have been poor for energy equity performance. Our playbook I'll admit there's no playbook for the biggest energy crisis of our lifetimes, but our playbook was we were going to be selling aggressively into that spike. We're sitting on about 23% cash now. We're told from a variety of trading desks in Canada that there's a lot of potential buying power that has been waiting on the sidelines, recognizing that the oil market going forward is a lot more bullish than it was 3 or 4 months ago. But it was just the volatility was paralyzing the funds of the flows of funds. So we're optimistic given a sector that is now discounting roughly $65 oil. We think that roughly 80 is going to ultimately be the floor for WTI going forward. We get to that because there's an enormous amount of restocking. You think about all of the inventories. We have onshore global inventories at their lowest levels in history for this time of year. We have U.S. inventories near either at or approaching their lowest levels in history. So there's a tremendous amount of barrels that would have to be bought. The U.S. SPR, global SPRs will have to be restocked. We think China, which has been destocking, will also have to restock. And so by our estimate, demand will increase by 450,000 barrels per day per year for the next 3 years. And so there's an underlying bid for the commodity. And just getting all of this unbelievable, nauseating, stomach and nausea-inducing volatility out of the way, where we have to spend our Saturdays following Donald Trump's Truth Social network. Hopefully those days are over. But again, we will not have details for either days, weeks, or up to 2 months.
You also mentioned that straight under the IRGC, which is the Islamic Revolutionary Guard, under that control is not and never will be, quote, open. What do you mean by that?
Yeah, it's a very, very important distinction. Again, we were in Washington. Our strong understanding from key participants in the area is that the major oil producers in the Middle East will not pay extortion, i.e. a toll or what was being coined, I think, an environmental fee to the IRGC. So the Kuwaitis, the Saudis, the Emiratis, I do not think will flow barrels through the strait and have to pay the toll. You do have workarounds in effect. There is a pipeline that Saudi Arabia very, very successfully leveraged to flow oil through the West. That really saved the oil market. We have the Emiratis that are building a workaround pipeline to get around the strait. That'll be completed at some point next year. But there are still all three countries going to be subjected to having to move seaborne barrels through the strait. And my strong impression is they are not willing to pay a ransom to the IRGC. And so it's something that's the biggest thing I'm watching. I don't care how many ships are leaving the strait. We're talking 80 million barrels of floating storage. Mm-hmm. Far more important is how many ships are actually entering, because the reason why we're down 11 million barrels per day of production still today is that onshore storage is full. It is backed up production to the wellbore. And until tanks are willing to enter the strait, we're ignoring all the sea mines and everything else. Until ships are willing to enter in and unload onshore storage, we will continue to lose 11-ish million barrels per day of production every single day. And so, yes, there are Greek shipping captains, we are told, paying the $2 million per ship fee. It's $1 a barrel. Mm-hmm. We have yet to see any indication using satellite image as of about 30 minutes ago that there are any crude ships entering into the Strait of Hormuz. So it's a very, very important distinction and something we're paying very keen attention to.
That's Eric Nuttall, partner, senior portfolio manager, 9 Point Partners. When we come back, we'll have a look on the markets as they react to the latest on that new agreement between Iran and the U.S. with Ian Schaefer. Back in a moment. Here are the stories we were following today. Oil prices falling after the U.S. and Iran say they reached an interim peace agreement to reopen the Strait of Hormuz. Now, both sides still need to decide on final steps before signing off on a memo in Switzerland on Friday. The plan extends the ceasefire by another 2 months and begins talks on restricting Iran's enrichment of uranium. Iran is meant to reopen the strait immediately after that deal gets signed. Canada's Industry Minister Melanie Joly is in China this week. She's meeting with 4 companies considering building electric vehicles here: BYD, Chery, Geely, and Shanghai Launch Automotive Technology. Joly's trip is looking to boost investment in Canada's auto sector. She says she wants to see Canadian companies manufacture for Chinese EV makers in factories and plants in this country. Shares of Canopy Growth edging higher. The cannabis producer posted a smaller loss in its fourth quarter and saw overall revenue rise 10% compared to a year ago. Canopy says the revenue boost was driven by higher sales in its cannabis unit, as well as its medical segment. The company expects net revenue to grow in fiscal 2027, helped by higher margins and cost-cutting measures. Here is where we are on the markets right now. The TSX liking the news coming out of the Middle East. It's moved up almost 1% or 329 points so far in the day. South of the border also in the green. The S&P up 1.8%, the Dow Jones up 1.25%, and the Nasdaq 712 points up so far, or 2.75%. So the S&P moving higher with oil prices lower and developments in the Middle East. For more on that market reaction, we are joined by Ian Schaefer, President, Chief Investment Officer at Galliant Advisors.
We saw the pullback, earlier in the year on the headlines for the Iran war. So obviously, I think a lot of people were positioning and saying, I don't want to be, short of the market or I want to be long the market once the headlines cross that there's going to be a deal. So I think that's what we're seeing. This is the knee-jerk reaction, which is, okay, it is safe to buy the markets because the geopolitical risks are waning. I can't say they're over. I don't think you can ever trust the IRGC to completely, follow through on the deals that they sign. But I think it's a sigh of relief where people are saying, okay, this is safe. I'm going to look to some beaten down sectors to buy those stocks or cover my shorts, which in turn also sends stocks higher. So this is definitely a positive response, but I think it's a knee-jerk reaction. The real test is going to be in the weeks ahead.
For sure. Do you feel also as though maybe the markets have been pricing an end to this conflict for some time now?
I think so. The way I look at it is I'm always taking a look at not just the market, but basically how oil is trading. So sometimes you'll see that there was, Israel may have sent a missile to Lebanon or vice versa, and you'd see the market go down, but oil wasn't really going down. I think the oil market was smarter and it was saying, I don't really think this is the beginning of a new, engagement. I think this is still, waxing and waning, leaning towards a deal, and they're finally getting the deal. So it seems like the prognosticians really had it right that this was going to be a short war. I think the ceasefire lasted longer than we thought. But again, I think this is just a sigh of relief and an early short-term reaction to a positive development, no doubt. But, is it securing long-term peace? We don't know.
U.S. midterm elections are coming up in the fall, but it will unfortunately be here before you know it in terms of fall. How has the S&P 500 reacted historically to midterms, and do you see a pattern like that happening again this time around?
Well, historically, the markets do well, in the 12 months following the midterms. But if you just think about it, if you look away from the data, you're a sitting president, you want the Republicans to do well in the midterm election. So obviously, Trump's agenda would be to, get the war solved, start hitting on his promises that he made to the American people, 2 years ago, and make sure that he's getting, a fair shake on the election results that are upcoming. So I would think if he can possibly get interest rates to get lower, I don't think he will. But let's just say a victory for him would be if they don't raise rates in spite of the inflation that we've seen. And now you have an excuse. I mean, people could say we could look through the short-term inflation because of the fact that you have a deal on the table. So even if inflation has not passed through the system yet, it will in short order, and also barring any new tariff announcements that might come. I think the market's already priced in what's already gone on there, but we don't want anything new. So his agenda right now is to put the Republicans in the best position to do well come November.
You mentioned semiconductor stocks have led to most of the recent gains that we've seen on the S&P. Do you think that trend will continue long term?
Semiconductors has been a major surprise. I mean, it did well last year, that group. And it's an easy first mover when you think about the move that NVIDIA has made over the years. And then you say, okay, so many people are trying to come and take a piece of that pie. So, okay, I can understand that semiconductors would do well because there's a catch-up play possibly on the earnings and valuations of the other makers. But to see every single semiconductor stock going up, what it seems 5 to 10% a day, I think that's excessive. So, I wouldn't be surprised. I don't think there's danger necessarily for, tech stocks. But if there's one area of tech stocks that I could see, give way a little bit if there's a little change, I would see semiconductors possibly trade as the market, but maybe not outperform the market. And other areas that have lagged, maybe the mega caps, I could see doing better come the run now into the end of the year.
Okay, you do have some stocks that are on your radar at the moment. I want to go through those. The first one is Honeywell. You say it's got some significant restructuring happening right now. What is it that you like about Honeywell, or what is it that you're watching for, I guess?
Well, they're taking the GE playbook where GE split itself into multiple different businesses, and Honeywell's doing the exact same thing. So come the end of the month, Honeywell is going to be spinning, the core business is going to be spinning out into a pure play aerospace business called Honeywell Aerospace. And then you have the remaining business, I guess we can call it Honeywell, which is going to be a pure play automation business, similar to a Rockwell Automation. So, yeah, and then lastly, Solstice was a company that they've already spun out to investors, meaning investors who held Honeywell stock are getting a piece of a new company. They already sold. They already spun out that stake last year. So now you have the makings of a company that's going from 1 to 3, turning into 3 different pieces. But more recently, also they just had an IPO of Quantinuum, their quantum computing piece. And while investors have not yet received a stake in that quantum computing business, we expect that down the road when Honeywell divests the rest of its shares, it probably will spin out. So you might actually get 4 pieces of Honeywell. And what they're trying to do is unlock value. They're trying to get analysts on Wall Street to say, okay, well, I couldn't value all of Honeywell, similar to how I can't value all of Berkshire Hathaway. But if a Berkshire Hathaway or Honeywell split into 3, 4 different businesses, I could say, okay, here's the insurance business for a Berkshire. Here's the aerospace business for a Honeywell. I'm going to map that against GE, another aerospace company. Or now the automation business, I can map that against Rockwell. Mm-hmm. So now you have these different pieces where the analysts can do their homework and say, okay, what's a proper valuation for that piece? And we think the sum of the whole is way greater than where the stock is right now. So for investors who are looking to benefit from this, from the spinoff, I think they should be getting into the Honeywell stock before the end of the month, as the spinoff date is June 29th.
Okay, Take-Two Interactive Software is another one you like right now. Why is that?
Unfairly beaten down in the software trade down, where people were saying semiconductors win, AI wins, software loses. A few of the negative of the companies that have suffered in this have been a Netflix, which we have yet to see it hit the numbers, but the stock hasn't been doing well, and Take-Two, which has its own catalyst for the end of the year, which is the release of Grand Theft Auto 6, which is going to be their huge behemoth release. It hasn't been released in over a decade, and the old titles are still making Take-Two a lot of money. But this is going to be a huge catalyst, and there's going to be a summer marketing release come in the next couple of months, probably a month away, and there's going to be a third trailer coming out. So I think those are going to be positive catalysts to the excitement that's going to build going into November, and I think that's where investors and ourselves at Galliant, where we own the stake, and we think we'll get some real nice appreciation into November when that release is upcoming.
Ian Schaefer is the President and Chief Investment Officer at Galliant Advisors. Up next, Canopy Growth shares rising today. We'll speak with the CEO after the break on the company's fourth quarter earnings results. Back in a moment. Canadian cannabis company Canopy Growth reported 27% net revenue growth in its Canadian medical cannabis business for its fourth quarter. Let's find out what is driving that with CEO Luc Mongeau. He joins us now. Thanks for joining us today.
Good morning.
So medical cannabis revenue did well. How much of that growth was organic versus contributions from the MTL cannabis acquisition you had?
The bulk of that growth was organic, and the acquisition of MTL came in the very last few weeks of fiscal 26. So all this was driven by the hard, dedicated, focused work of our teams as we continue to improve the quality of the services and the products that we provide with our medical patients across Canada.
Okay, obviously, as we know, you operate in other countries in the world as well, distribute there. So international cannabis revenue increased by 68% in the Q4 time period for you. I know there were supply chain challenges previous to that. So was this a rebound effect?
It was absolutely a rebound effect. We've proven in Europe when we have quality flower available, we can do extremely well. Sadly, we were challenged during fiscal 26, and we focused quite a bit of effort in making sure that we reset our supply chain, our global supply chain. So lots of effort going into cultivation in Canada and into deploying resources in Germany to make sure that we could reignite this market. And we're thrilled and we're encouraged by what we saw in Q4, a 68% growth year over year. I was in Germany and Poland last week. Our teams are ready. They're on the ground. We've already rebounded in Poland, where we rebounded to number 3 position in Poland behind availability of great flower. We've shipped our first MTL strain to Germany very recently. So we're very confident that we will achieve significant growth in fiscal 27 across Europe.
Okay, so what was the challenge with the supply last year? Was it quality of product? And I see you have an inventory charge of $10.7 million. I'm wondering if that has to do with switching suppliers.
They're separate issues, and at Canopy we aspire to be one of the global leaders in bettering lives through cannabis, and this starts with quality flower, quality flower grown at scale, efficiently, consistently, and frankly, our system and our resources weren't geared to produce that reliability, that consistency, that quality of flower. So that's why we went back to basic. We re-engineered the business. We acquired an MTL, and one of the key drivers of the acquisition of MTL Cannabis was their know-how, their knowledge, their capabilities in growing good quality at scale. And we're now in a position with the integration of MTLs. We've been operating together for the last couple months. We're seeing tremendous improvement in the quality, the consistency, the efficiency at which we now grow flowers. And we're confident now of the robustness of our global supply chain to bring great products to Europe.
All right. Now, the $10.7 million charge for inventory, how did that originate?
Yeah, that happens. This type of things happen when two companies get together, where you've got redundant inventories, overlapping inventories, brand, product categories, and everything. So we moved swiftly in the first couple of weeks of our integration to make sure that we would start fiscal 2027 with what you would call a cleaner slate, where we've got focused inventories, focused portfolios of brand and SKUs to really continue that growth that we saw in fiscal 26, both in Canada and in Europe.
Okay, so that would be a one-time charge there.
Absolutely. Okay.
Adult use cannabis revenue grew only 1% for the last quarter, despite stronger performance in vapes, I guess, and infused pre-rolls. So what's preventing faster growth in that segment?
Yeah, there was a bit of a slowdown in the last quarter, but the trends are about 3 to 5% growth in the Canadian rec market. And for focused discipline LPs, operators in Canada, there's still tremendous opportunities for growth. For us, we continue our efforts. Our brands are stronger. Our portfolios are stronger. We invest more in innovation. We're focused on 3 categories that still represent for us a tremendous amount of growth. It's flower, high quality flower at a variety of prices. It's infused pre-rolls and pre-rolls that are still growing extremely fast, and vapes as well. So we're very confident in the underlying fundamentals of the market that represent tremendous growth for Canopy.
Okay, you're also in medicinal marijuana. The U.S. is reclassifying that to more align with the states. How does that affect your company?
Yeah, for us, I mean, there's no real impact short term, man. We're very disciplined. We're focused. For us, we've been very clear, and we've been saying the same messages. We're focusing on the fundamentals. We're building really strong foundation in Canada. We're focused on the near-term opportunities that will drive Canopy to positive EBITDA and positive cash flow generation. So for us, it's Canada and it's Europe, and it's paying off for us as we saw in fiscal 2026, and we move into fiscal 2027 with really good momentum. So we will not move away from that focus strategy. That being said, we know the US market will eventually be an extremely large, sizable market, and we're very encouraged by the positive inclination of this administration to gradually change the regulation of the market. So we saw improvements on the medical side of things. Does not impact Canopy, but it's a great move in the right direction. And we're staying close to what this administration is doing with the cannabis market.
Okay, the last quick question here is about the illicit market in Canada and what challenges, if there are still challenges that remain there.
Yeah, I mean, it is still a very large market. For us, with other LPs, we focus on improving the quality of our products, the quality of our innovation, and working on efficiencies and cost control to make sure that our products really honestly rival and exceed the performance of the illicit market, and where consumers turn more and more to our products when it comes to satisfying their needs.
All right, I do have to leave it there. We have Luc Mongeau. He's the CEO of Canopy Growth. Thanks for joining us today. Appreciate it.
Thank you very much. Have a great day.
Coming up, Elon Musk back in the headlines, predicting SpaceX revenue could reach $1 trillion within 5 years. More in a moment. After dominating the world's attention on Friday, Elon Musk back in the headlines today. He's predicting that his newly public SpaceX could see its revenue soar to $1 trillion in 5 years. Musk made those comments on X in response to our own BNN Bloomberg contributor, John Ehrlichman, who joined us with more on the story.
Obviously, it was a big day for the IPO, but Elon Musk wasn't doing any interviews. And, when I shared this information on X about Morgan Stanley's estimate last night, that was already considered, because in the business of valuing companies, it's based in part on where a company is going to be, not where it is today. The fact that Morgan Stanley had been one of the first research firms to come out and boldly predict how much revenue growth SpaceX could see was something worth talking about. And their projection was for $330 billion in revenue by 2030. Now, just a reminder to the audience, revenue has been growing at SpaceX, but it wasn't even at $19 billion last year. So that's a pretty lofty number. So for Musk to then very quickly respond to my post and say, I think $1 trillion in revenue is quite achievable by 2030, and certainly an even greater number by 2031, that got me thinking about how they can do it. And we don't know until we see what happens with this space rollout. But I think the simple way to think about this is the power of AI compute. So if you have been following the SpaceX story, they have built out an AI business within SpaceX. They're actually right now renting a massive amount of data center space to Anthropic and to Google, which, yes, they're using that compute for their own AI, but they're also building and benefiting from renting in the short term. The concept here is that the next step will be going into space, using their launch vehicles, using Starship, which is not operational yet, but is expected to carry heavy loads, build data centers in space. I know it sounds, Lindsay, a bit fantastical, but if they can pull this off and the AI compute demand stays as strong as it has been, just as a context piece here, in their Memphis Colossus data center on Earth, right now Anthropic and Google are paying SpaceX about $2 billion a month. And remember, their revenue last year was about $19 billion. So I guess that's what Musk's thinking here, and we'll have to wait and see.
Just very quickly, that SpaceX investor, Chad Anderson, also told you about 3 other space stocks that he's watching. Which are they?
Yes. So Chad Anderson, bullish investor on SpaceX, who we spoke to on Ticker Take. 3 names he'll continue to watch would include Google, which, yes, is renting data center space from SpaceX, but is also a SpaceX investor. And if you think about the way we get around the world, Google, a big player, along with Trimble and Rocket Lab, the others he's watching.
BNN Bloomberg contributor John Ehrlichman there. Market Call is coming up next. Today on the show, we have Gordon Reed. He's president and CEO of Good Reed Investment Counsel. His focus will be American equities. We'll shake out a bunch of different things with Gordon on the show. That's coming up next. And a quick look at how we are doing on the North American markets with the TSX benefiting from that conflict in the Middle East coming or nearing some conclusion. It's up 327 points, or almost 1%, 0.94% on the day so far. Let's go south of the border. Or before we do that, West Texas Intermediate, this is the July contract. It is down 5.5%, or $4.65 to that $80 mark, 80.23, on news that, again, there is some conclusion, hopefully, to that war. The U.S. president announced there's some sort of agreement, details to be decided and expected to be signed in Switzerland on Friday, which is why you're seeing oil prices drop today to around that $80 mark. Let's have a look at where gold stands right now. This is gold futures for August, and it is moving up as well. It's up 3%, 3.3, or $139 to $4,378. And we'll check on a couple of gold stocks right now to see how they're doing. We have G Mining Ventures, which is up 15% today. So that is up $5.58 to $42.81. Aris Mining also up double digits, 10.5%, or $2.33 to $24.40. And then Kinross Gold also benefiting. It's up 8% flat, or $2.86 to $38.62. Then a quick look at the markets before we end the show. And again, a streak of green today for the American markets. The S&P is up 1.9%, almost 2%, or 140 points. The Dow Jones, an incredible move here of 1.4%, or 700 points. And the NASDAQ up almost 3% on the day, or 768, as some of those tech stocks rebound today with a hope of an end to that Middle East conflict in full and a reopening of the Strait of Hormuz. That does it for Morning Market. Thanks very much for joining us. I'll bring you Market Call in just a moment. Stay tuned.